Today, we've got a lot of really cool things to talk about. We'll see where this conversation goes. But yeah, I'm Eugene. I head up like everything we do with stablecoins here at BitGo. And I'm here with Simon, who I think you technically head up everything on what's called crypto distribution, but effectively
That's right.
stablecoins. Is that right?
Yeah.
Okay, cool. And so Simon was previously at BVNK as the chief product officer there, has also kind of a cool mixture of like TradFi as well as like crypto experience. So super happy to have you here.
Yeah, happy to be here. Looking forward to it.
Very cool. All right, so we'll have like kind of two segments in this conversation. The first one is going to be sort of just like genius and sort of talking about like 1 year out, like what are our thoughts, what are the challenges, things like that. And then second part, we'll kind of talk more about your guys' strategy and love to talk with this group more about what you guys are thinking.
Yeah, sounds great.
Okay, awesome. So I guess we'll start with like maybe the first question, which is like 1 year out from Genius, like does it deliver on some of its promises? Like how does SoFi kind of like live within those constraints as well as like see opportunity?
Yeah. So I think it's fair to say, by and large, as we've taken that act and we've started to turn it into a notice of proposed rulemaking, broadly speaking, I think, the regulators have delivered on, the lion's share of everything that was kind of carved out. Obviously, at the stage we're at right now, obviously we're going through a pretty meaningful comment period where you've kind of got sort of two camps in relation to Genius, right? You've got the sort of the financial institutions, the TradFi guys, and you've got the crypto guys. Some, moving into that realm of becoming national trust banks, or certainly, very interested in stablecoin issuance. And then you've got the other side where sort of, a little bit defensive around kind of bank deposits and sort of how those things work. But I would say by and large, the initial goals of the Act are very much kind of being transformed into the rules. I think from our perspective, certainly, the areas that we see probably be kind of like the main cause of focus are really sort of threefold. Number one is, I think, I'm not a lawyer, but for the lawyers, there's definitely an element of precision that the associations are going to be looking for in terms of some of these terms that are being used, right? Is yield that well defined? Is interest that well defined? And also some of the applications around kind of the utility for stable coins and making sure that those things are very, very crisply defined in general. I think the second piece is actually some of the things that are coming out of this are actually a lot more around sort of liquidity and concentration. And so, as part of the proposed rulemaking, there's actually some language in there that really requires issuers to hold no more than 40% with a given financial institution. And so, in general, one would say, okay, well, if you're taking a fiduciary responsibility, that's a pretty logical thing to do. However, there's a number of scenarios where actually that could in itself create other types of like liquidity risk and liquidity issues. And I would say the third bucket is very much around how kind of the agencies work with each other on these themes. And so specifically, there is a lot of regulation and rulemaking around, what this means for the issuer itself, but very little in terms of, what this means for the banks, for example, holding those reserves. And so I think, the kind of coordination across the agencies, I think it's going to be a really important part of the next step. Maybe the final part of that is, well, it's just been interesting to sort of see, so some of that information come from both the FDIC, the Treasury, as well as the OCC so far. And so I think there's inevitably some kind of period of harmonization where these things will get trued up. But overall, I think the outcome is probably certainly in line with expectations.
So like zooming in on that yield part, that's the most fun part of this conversation. And like the definitions that you're referring to. How does how do you guys, I guess, interpret that, and like how do you kind of think about the different use cases here that are like restricted or not restricted around yield and interest?
Yeah. So again, I would say the general sentiment is, and I think what the Act is fairly clear on, is this whole idea that platforms holding stablecoin for the benefit of an end user shouldn't be paying yield, right? And I think that piece is generally upheld, within the proposed rules. I think where things are a little bit less obvious is actually how issuers can work with other institutions for distribution. And so that's definitely an area where a little bit some of that precision that I touched on would actually become very helpful, because fundamentally in a world where stablecoins are converted at a rate of 1-to-1, if you want to generate distribution through other institutions, it's reasonable that you would, provide some type of incentive or reward for that activity, in much the same way that you would use affiliates to help with marketing. We don't see it wildly different. And so I think for me that's definitely an area that, we're interested in sort of seeing, how the regulators sort of perceive a little bit more of that B2B activity, whilst I think certainly upholding the kind of the general premise around the goals for the consumer.
Got it. That makes sense. In terms of like the provision that allows for like a loyalty program-esque type of thing, is SoFi like considering that for members, or like is there anything you can talk about there?
So I think we would very much bifurcate between stablecoins and tokenized deposits. Tokenized deposits being something that banks do today. I mean, it's just a blockchain representation of a deposit where things like interest, things like FDIC insurance are just commonplace. Existing rules that already cater for that. Look, again, I think we'll wait and see what comes out in kind of the final rulemaking. There's certainly a lot of lobbying going on this topic for obvious reasons. At the end of the day, though, if holding a stablecoin on a platform starts to look an awful lot like a bank deposit, and with the promise of interest, I think that's where some of those issues come out.
I see. Cool. Thanks for answering that. I think we forgot to say this, but these are all of our own opinions for both of us. So just probably healthy to say that. Okay, so the next topic, I guess, around Genius that I'd want to dig into is like your comments about liquidity, and obviously a lot of that's like working with market makers, distribution, venues, et cetera. As a bank, I guess this is the first sort of FDIC bank like regulated stablecoin. What are your guys' thoughts around like what you're doing there, and like how do you interact with these different players that are largely like crypto native?
Yeah, so obviously we've got a great partnership with BitGo, where we announced you guys as the first liquidity partner to help with distribution, and I think that's really important. Look, I think if you sort of zoom out, right now we're looking at an environment where stablecoins are largely used in very kind of crypto native ecosystems, e.g., crypto trading, DeFi protocols. And again, if you sort of look at some of the data that came out, and I think McKinsey did, a study that they published in Q1 on this, actually of the sort of annualized $80 trillion of stablecoin based on the back end of last year, around 380 billion of that was actual kind of pure payment activity. So it really feels like we're 100 meters into a marathon on some of the more TradFi style use cases that we think will explode. But I want to kind of bring that back to the question that you have, right? Because at the end of the day, these are cross-sided network effects that you have to build. And so, we think liquidity is kind of very much at the epicenter of like solving that problem. And so as of today, right, the places that people find liquidity, or the places that they find supply, is typically the centralized exchanges, the decentralized exchanges, and the market makers. And so I think it's an important part of that rubric that issuers can establish relationships with each of those actors. But at the end of the day, I think the goal that we certainly see, and certainly the opportunity, is like, if you zoom all the way out and you say, okay, well, how big's like the payments industry? How big's like B2B payments? And if you estimate it somewhere between 80 and 90 trillion, again, that's where using some of the sort of traditional crypto natives is probably not necessarily, the only answer for sort of the longer term. And so from our perspective, it's very much about kind of establishing relationships both domestically and internationally where we can solve those problems for both, the end users, but also any kind of businesses, that intersect with the infrastructure.
Got it. Makes sense. In terms of like just the landscape of stablecoins, given Genius, given some of the requirements in place for like who can issue, who can't, what are your thoughts generally around like what that landscape's going to look like? Is it going to be there's like 10 winners in stablecoins? There's going to be 500 stablecoins? Like what are your thoughts there? Especially with like banks in particular, curious your thoughts.
Yeah, so I gave Eugene a little bit of a preview on this one ahead of time, but I think I've kind of flip-flopped. Originally, I thought we'd probably be somewhere in the sort of the 5 to 10 stablecoins to sort of, to win. And then I sort of very much flip-flopped and said, actually, no, I think there's going to be like 500 stablecoins, and we're going to have to figure out like the interoperability. And I think I probably swung the pendulum back in the other direction. And the reason I say that is actually the unit economics make very little sense for only a small number of issuers. So what do I mean by that? And again, BitGo, you operate a national trust bank. We operate an insured depository institution. We'll have an operating subsidiary that is ultimately the issuer for us. But I think that the check size to sort of be an issuer is somewhere between 50 and 100 million. And so therefore, unless you're practically in the top 10 stablecoin issuers on the planet, you're unlikely to break even. And so, given that fact, I think the real question is, what is the advantage for the institution who wants to either create their own stablecoin or fundamentally issue stablecoins more broadly? And how do they make the unit economics make sense? And so I think that kind of brings me back probably closer to a number closer to 10 than 500, but certainly a number less than 50. Maybe the final part is I think when it comes down to it, though, that interoperability question is probably the bigger problem that's going to need to be solved. And I think that's the good news is there's a number of like market utilities out there, players like yourself and others that actively solve those issues today. But I do think that's going to become increasingly challenging because, you know, stablecoin A, if it's not interoperable with stablecoin B, will have a significant impact on the viability of both.
Yeah. I think I've gone through that like roller coaster of emotions too about how many stablecoins there are going to be. But we'll probably get to 500 and then like we'll see it maybe taper off. Yeah. And actually at BitGo, obviously we offer a stablecoin as a service product. So we talk to like basically most people who are either regulated financial institutions, fintechs, platforms. Like they come to us to try to figure out like how to do what they're trying to do. And it's interesting. I think we get a mix that like kind of go by your thesis. We get some that realize like the overhead that comes with it. And it's really not overhead they have to deal with. It's like BitGo deals with it. But just understanding it like makes them kind of like think through like what are our other options. And then there's some I think that it really encourages them to go forward. So I don't know. I think at BitGo like we're hopeful to see a lot of successful stablecoins get issued and used for different use cases. But totally think that take is super valid. Maybe let's shift a little bit away from like Genius and regulatory for a little bit, and love to just talk more about what you guys are doing at SoFi with stablecoins, like sort of the thesis behind SoFi USD, and maybe start there, and then we can see where it goes.
Yeah, sure. So I joined SoFi at the start of the year, and what's been kind of incredible to me personally as an employee is just sort of seeing actually the breadth of the products and services we offer. And I say that because, you know, yes, you know, as part of our holding company, you know, we have a bank, we have a broker dealer, but we also have a very successful software as a service arm as well. And so when you sort of look at that landscape, you know, we have 14.6 million consumer customers, it was announced today, but we also serve hundreds of institutions from the software as a service business. And a big part of that is actually working with the card networks around kind of being an issuer processor. So last year, you know, I think we did over 8 billion transactions with the MasterCard network alone. And so when you start to look at this landscape of saying, well, stablecoin adoption is coming, it's something that consumers are naturally moving towards. We've seen the adoption rates just broadly. We generally, in terms of the, I guess the kind of the mix of our members, you know, have members that are typically a little bit more tech forward, and therefore are naturally kind of either crypto native or crypto curious. And so we could see this kind of this trend happening in the market anyway. But coupling that with sort of the adoption from the networks themselves, you know, we saw this fantastic opportunity not just for institutional distribution, but actually distribution on the consumer side. I think the second part to that is just being an insured depository institution. I think we have quite a unique position in the market in the sense that we can actually provide tokenized deposits, and those tokenized deposits can pay yield. We can provide FDIC insurance relative to kind of, you know, the overall limits. But it is something that we're very, very mindful of, like the sequencing of rolling these things out, particularly as we're in an active rulemaking period. But the big picture for us is, you know, if you look at, say, some of the most successful stablecoin issuers today, they generally only have an institutional distribution arm, and we see it as a competitive advantage to have both the combination of millions of consumers that are already working with us, combined with this amazing institutional landscape that we can offer our products and services through.
Got it. And do you see a world where like other banks are using SoFi USD as well, and like settlement rails are happening in that capacity, or do you kind of see it more as like an ecosystem that centers around your members and what they're trying to do with their money?
It's a great question. So if you'd asked me that question before I joined SoFi, I would be like, absolutely no way. This will be primarily focused on our own customers. In fact, actually, we've had an incredible response because we've talked to community banks, we've talked to credit unions, we've talked to regional banks, some super regionals, and even some insurance companies. And I think there's naturally just interest in working with stablecoins issued by an IDI or an operating subsidiary of an IDI. So we definitely think that there's opportunity there. Again, I think it comes down to this sort of this broader challenge that the financial institutions in the US still have, which is, man, you know, depending on your opinion, whether it's 1 trillion or 5 trillion, but there's some component of deposits that we expect to move into stablecoins. Now, I'm not going to express my opinion of where we land on that scale, but I think we can also say with confidence it's non-zero. And so depending on the type of, you know, financial institution you are, you'll perceive that risk to be higher or lower. And, you know, then the question is, okay, well, how do I interact with this new technology? How do I support my customers, whether they're businesses or consumers, but actually handle this kind of potential deposit outflow. And I think, we're certainly working on some ideas, around supporting kind of those ecosystems, some of which could be as part of a consortium, some could be just kind of like, direct relationships.
Got it. That makes sense. One other thing too, I think, sorry, I didn't put this in our prep, but I'm going to ask it anyways. I know you guys had a recent announcement with like MasterCard, obviously, and what you guys are doing with them. I think maybe like folks would be curious, like how you guys are working together and what that you can share and like meaningfully, what does that mean? Like, what is like your guys' proof point to work together?
So as I mentioned, we already have very, very deep relationships with both the card networks, and so for us, as we look at sort of moving from a settlement cycle of kind of once a day, 5 days a week, to multiple times a day, to 7 days a week, to potentially 24/7, the value prop to a card issuer or a program manager to be able to settle in real time to fundamentally reduce the collateral requirements is extremely meaningful. And so you can solve that problem without actually being, as a sponsor bank yourself, without actually having to take in stablecoins and simply just use this for the settlement rails. So we see opportunities, we work with a lot of sponsor banks already today, of like using SoFi USD as a method to, settle those commitments to the card networks in real time. But really the main use case there, it's not so much just the speed of settlement, it's really how do you leverage the technology to reduce your collateral requirements and your pre-funding requirements. And so that's kind of like the headline opportunity. I think the second part, though, is we already work today with issuing programs that are actually built on top of stablecoin rails. And so in a world where, those card programs can effectively, pre-fund in stablecoins and also settle the network in stablecoins, I think that's a really powerful use case as well. I think, that's been the primary focus, but certainly we see opportunity actually on the other end of that spectrum, which is on the acquiring side and the merchant side. And again, I think this is where the flywheel effect, that the network effects that we're trying to build really come into play. Because if you've got millions of people holding SoFi USD and they can use it for commerce, they can use it with merchants, and fundamentally the acquirers don't then need to switch it out back into dollars to settle the networks, we think that's a really powerful use case.
Yeah, it's like one thing that we talk about a lot at BitGo, and I probably have my own perspective on this too, is like, everybody talks about payments right now with stablecoins and cross-border remittance. Like those are the two like hot topics. The challenge though is it ends up being like basically all B2B, because like there's no regular person who just randomly has stablecoins.
Yeah.
And so it kind of comes down to supply, right? Like I don't get paid in stablecoins, my bank doesn't remit stablecoins, and so I don't have stablecoins. So like, do you guys see a world where like, is that sort of the first part of the plan here with your members? Is that like, that solves the supply and then you guys are sort of building that ecosystem outward? Is that kind of the idea there with payments?
Yeah, absolutely. And again, you need both the supply and the demand, right? It's all well and good having kind of a fountain of supply, but if there's no demand, it's somewhat useless. And so certainly a big part of the program that we're building out is to create utility, not just for consumers, but for institutions with those stablecoins, whether that's in sort of traditional crypto style use cases or whether that's in kind of more traditional finance style use cases. And I think, in fairness to the existing stablecoin issuers, they've generally done a very good job of like both of those things. I think what perhaps though some of the feedback that we've had is, at the end of the day, when you start to talk about the potential scale of the traditional markets, the issuer risk, the counterparty risk that exists inherently with a stablecoin issuer, are they investment grade in nature? Can I look at kind of Moody's for kind of sort of, some of those sort of credit-based indicators? I think that's where an organization like SoFi has a bit of a competitive advantage, because of the fact that, we're a public company, but we're also kind of an insured depository institution. So I think we can provide some slightly different protections in that way.
Yeah, and that's a really good point too, that I think regulators maybe even haven't really thought about too much, is that point you're making, which is like, how does a regular consumer know which stablecoin to trust? And even if everybody's sort of like genius, there's also obviously, there's going to be lots of venues that show things that are like issued outside of the US. There will always sort of be these like gray areas. So I think that's a really great point that, looking for folks that have that reputation to prove it makes sense.
Yeah, and I would say, fundamentally, like that's where kind of brand awareness is so important, right? And again, I would say, the existing stablecoin issuers have generally done a good job of like creating brand awareness and creating trust. But I think when you look at, let's say, some of the largest enterprises in the world and some of the, the larger traditional finance players, their trust comes from different metrics, right? It comes from observing credit, understanding liquidity profiles and those things in a slightly different way.
Yeah, that totally makes sense. Going back to what you said earlier about like tokenized deposits and like your guys' sort of ability to do that as like standard business, like how do you guys see SoFi USD and like future SoFi tokenized deposits? Like what does that look like, and how, like from a member's perspective or like someone who's a SoFi customer, like what would their interaction be between those two items?
Yeah, it's a great question. So the best analogy I can give you guys is, if I had $100 bill in my pocket, and I gave it to Eugene, and it's bearer in form, right? By Eugene holding it, he's basically, the owner of that. You take that same $100 bill and you put it behind a bank, it becomes a bank liability. So the actual technology, the piece of paper, hasn't changed, right? But the legal context has, and it's very much that same idea. You could make the same case with a silver dollar coin. And so we very much think of it in the same way. The thing that establishes the tokenized deposit is the combination of the asset and a deposit agreement. And only a bank can, issue deposits and, operate with the FDIC insurance and those things. And so we're fortunate to be able to do both. Obviously, as we get into a post-Genius world where our stablecoin gets issued by an operating subsidiary of the bank, then there's other nuances that, for us to figure out. And so as it stands right now, our primary focus is on launching the stablecoin, but our expectation is that we'll be able to launch a tokenized deposit here, hopefully in Q3.
Got it. I see. That's a really good analogy with the cash. I think a lot of banks actually are kind of like struggling with this decision, and they end up running them side by side as like two different projects, and then they're sort of like missing maybe that transition point, which is like how do you go from one to the other, and like what does the consumer expect, or what does the customer expect?
Yeah.
Okay, cool. Maybe let's like pivot very slightly into something that maybe is more akin to like this conference, since it's a Bitcoin conference. But like any thoughts around like how does SoFi see chains and obviously Lightning and these other networks? Like does SoFi have plans, or how do you guys evaluate what chains you're gonna bring SoFi USD to?
So I think it's a really important question. Actually, in many ways, it's probably one of the most important questions as a stablecoin issuer. Actually, we already work with the Lightning Network today. We have a product called SoFi Pay that leverages the Lightning Network for cross-border remittance today. So you can think of this, much like the stablecoin sandwich or the Bitcoin sandwich, where we're really just like leveraging the technology to move value cross-border, but ultimately with payouts still taking place in kind of local currency. So we absolutely see a world where that's possible. I think the challenge with any network selection is liquidity, right? And so for obvious reasons, you could say, well, this chain is, the high number of transactions per second, it's cheaper, it's faster, we're more confident in the smart contracts. But I think the much bigger question is utility, right? So if we pick the cheapest, fastest chain, but there's no liquidity on that chain, then the utility is pretty de minimis. And so, as we go through it now, there's really a couple of like main key considerations, and most of those are use case driven. Number one is we really talking about use cases that are focused on consumers, and if we are, practically there's a very small number of chains that you can consider for those use cases, right, which are all public and permissionless in nature. When you then start to look at some of these institutional use cases, the things that get much more interesting is understanding kind of what some of the privacy considerations, whether that's achieved through kind of like zero knowledge or fundamentally actually having permission chains themselves. So we certainly see a requirement to actually operate with multiple chains. But again, I think it's going to be a little bit more use case dependent in terms of which of those we ultimately select. And certainly wouldn't rule out working with Lightning on that context as well.
Got it. Makes sense. Maybe last question, and then we can move to questions if anybody has any. Obviously, you guys work with BitGo, and you chose to use stablecoin-as-a-service to launch SoFi USD. Would love your thoughts around like the pros and cons of that. Don't be shy. You can say the cons, but I think it's an interesting prospect, especially like as a bank to work with someone like us. And so I think it might be interesting for folks who are watching about like your guys' decision criteria, where you saw opportunity, how you think that'll work in the future.
So this is where I say how great Eugene is at his job, right? And he is actually fantastic at his job. So for us, I think that there was really kind of three key decisions. Number one is, do you have the competency to manage the tokens in quite the right way? And I think we're intellectually honest at the time of the journey. The answer was probably not, right? Particularly given the fact that we're a bank. We're the first, US insured depository institution that's actually taking this on. And so for us, having complete confidence in someone to operate the technology for us was critical. And obviously BitGo was one of a small number of companies that we felt could even be looked at under that regard. I think the second part is actually sort of being able to work with the right company. And I think this is where you guys have really just shown to be great partners, because for us, speed is a really important driver in everything we do. And so to be able to move quickly, not just from a technical perspective, but from a legal perspective, from an operational perspective, from an attestation perspective. And I think, those things are all paramount and equally weighted. And then I think the third piece as well is, for us, actually, with any strategic partnership is there breadth to the relationship, right? Is it just this one thing that we're interested in doing, or are there other avenues? And again, the fact that you guys have, call it 5,000 institutional customers that you already work with, so there's kind of like a homegrown distribution that we could leverage there as well, became really important. So yeah, for us, it was kind of like probably those three main factors at the top of the list.
Very cool. Sounds like we did a good job. Thanks, Simon. All right, cool. I guess maybe, I don't know if we have another mic, or I can hand this one around, but if you guys have questions, we can take any.
I have a question.
Yeah.
As you expand the stablecoin to more retail, not just B2B, as you expand the use case of a stablecoin to more than just B2B into retail, what kind of plans do you have for the tax reporting, given that stablecoins now, if you spend $1, it's a taxable event. And this past year with the 1099 DA, there was a lot of challenges and a lot of de minimis reporting, under a certain amount. It's very, lots of forms for very small amounts of money. So what is your plan to deal with that hurdle, given that stablecoins should ideally just be, buy a cup of coffee? It's not a taxable event, but right now it is.
Yeah, it's a great question. So we actually launched all of the kind of the tax reporting available for our members in Q1. So, we have all that capability in there. I think, the other part there as well is there an expectation of kind of profit or interest? And so, depending whether we're talking about tokenized deposits or stablecoins, those things get factored in. But I think look, the headline is we will continue to see market utilities needing to be developed and evolved so we can actually support consumers to make the technology easier to use, right? One of the, as a personal matter, like I'm a Bitcoin maximalist. I think Bitcoin's, the purest of all the cryptos. But at the same time, it's a very hard asset to actually make payments with because of all the tax consequences, right? And so I think that's why stablecoins have got such market traction, and certainly why we're extremely excited about some of those opportunities. But again, acknowledging some of those dynamics around kind of tax and reporting and things. But again, from our perspective, we've already released a lot of that functionality already to our members.
Maybe just to add on to that, I think Genius actually helps a lot with this, because I think Genius is purposefully classifying stablecoins as a payment instrument rather than an investment instrument. So I think like that clarity, once enforced, will probably drive a lot of the changes that we'll see around like how systems should operate from a tax perspective as well. Because like to your point, like cash as a payment instrument doesn't have any of those considerations. So I think once that's sort of enforced and defined, the next step will be like, what is the IRS supposed to do with that type of guidance around payment instruments? Right now, it's still a little confusing. I also think right now, like the hard part too is stablecoins are a lot of their usage is still in speculative trading and like as on the other side of a pair, right? And so it's quite difficult. Like if you were the IRS, it'd be like, well, like how should I actually look at that? It might be kind of hard. Versus I think like going forward as other use cases emerge that are not just related to trading, then I think like that its position as a payment instrument will be pretty clear. So hopefully that's helpful. Any other questions? All right. Well, thank you guys for attending.
Thanks, guys.
And thank you, Simon, for coming up.
Thanks.